Welcome back to the ValueHunt podcast. And today we have here Bradley. He is a young investor, not as young as me, but I can really relate to his story, and I'm very curious to know where the chat will lead us. So why don't you introduce yourself and tell us a bit of who you are and what brought you here?
Absolutely. Well, thank you, David, for having me on your podcast. Really appreciate it. It's a huge honor for me to be here with you. I'm somebody who is endlessly curious. I'm always learning, always adapting. I think that's really fundamentally what investors and business people should do. Um, Importantly, now I'm moving into a phase of not only having learned about investing over the past decade plus, but also trying to share some of what I've learned in my process with other people and connect with other value investors around the world. So I'm coming to you from Detroit. David, where are you in the world?
Yeah, so I'm in Portugal. Just, I would say, some difference in the time zone. For me, it's night. For you, maybe afternoon. I don't know.
Yeah, it's 4 o'clock here, nice and sunny out. And the Detroit Lions just lost a football game, but other than that, we're doing
Oh,
really well in this part of the world.
great. So now that you've introduced yourself and told us a bit of your passions, also maybe football, I don't know, give some hints. But what really ignited your passion for investing? Because before starting the recording, you we were talking about how young you started in this world of investing, and I'm curious to know what really sparked your first interest.
Yeah, so like many investors, I think there's really only two main reasons why somebody gets interested in investing to the degree that you and I do. The first reason is either they don't come from having a lot of money or wealth in their family or in their background, so there's a need to learn how money works. And when I think of people like that, somebody like Lee Lu is somebody who comes to mind. They grow up with not having incredible means of wealth and growing in very difficult conditions and having to overcome a lot of adversity in their life, and they become very risk tolerant and resilient, but curious to learn how money works, and they get very good at it. The second type of person is somebody who comes from an affluent family where they're already very wealthy, very successful, very prestigious and competitive, and they might have a little bit of a chip on their shoulder or feel like they need to keep the family name going and prove something to the world. And people like that, I feel like Bill Ackman is somebody who comes to mind. Um, so I think those are the two main reasons. And from my background, I don't come from a lot of wealth. I also don't have strong opinions about what other people care about me. And so, fortunately, those two things tied together make for a pretty good business person and investor for the approach that we take here. Um, I probably got interested in investing from such a young age because I don't come from um, that really wealthy background, and I wanted to always make more money in order to change my circumstances for myself and for my family. When I learned that it was possible to buy a dollar for less than a dollar, that idea really resonated with me, and it also struck me that the world's greatest investors, people like Warren Buffett, they have the same angles to their mind. So it seems to be true that most of the investors and business people, they instantly get that idea of buying a dollar for 50 cents, and it just kind of clicks with them and sticks with them. So when I learned that I could buy a dollar for less than what it was really worth, um, that's when I really kind of, it was like a lightning bolt struck me, that idea. And I just kind of understood the game and got really curious about it. And it's also amazing that you can tell somebody that this is possible through an approach, value investing approach, that you can buy something for less than what it's worth, and it will fall on deaf ears. So it either really clicks with you right away, or it doesn't seem to click with you at all. For the people who it doesn't seem to click with, it seems like they go and spend their money instead on buying things other than assets, buying handbags or shoes or other things like TVs. But uh, so for my background on investing, I like to think of investing as always being on the right side of the trade, on the right side of the transaction. I think everything in life is a transaction, and it's sort of a contract that you sign from the moment that you're born. It's a rule that exists whether you know it or not, and the rule is buy things well, or to buy things for less than what they're worth. And so you can see there's these case studies of people. There's one guy who traded paper clips up into a house, right? And so when I saw that that was possible, I knew it's definitely uh, possible to acquire things for less than what they're worth and trade over time. So I just kept reading about investing. I've probably read every book on value investing in the library that you can think of. And fortunately, knowledge tends to compound over time, just like your investments. So what I like about that is, once you really know something, nobody can take that knowledge away from you. I could lose everything in my investment portfolio tomorrow, but I wouldn't lose the knowledge that got me to the point that I'm at right now. And I think it would probably take, just 3 to 5 years, or maybe even sooner, to get back to a decent point, just because of what I know now through reading. So investing is really, one of the few things in life where you can really learn everything that you ever need to learn just by reading books, reading annual reports, reading shareholder letters. And that's why I'm so fascinated by people like Charlie Munger, by people like Warren Buffett, is because they're always reading, but their approach is so inactive that I was always wondering, how are they making all this money? And it seems like they're never even getting off their ass. And I think that's probably really true. I have some friends who go into things like real estate investing and flipping houses and
Yeah.
starting businesses, and it's just so active, and there's so much sweat equity and stress involved, and they're putting in so much effort. It's like watching somebody roll a boulder up a hill. But my approach and your approach and the approach of Warren and Charlie is you can just sit on your leather chair and read and invest, and if you make a few good decisions, it'll pay off really well over time.
Yeah, I think that's really beautifully put. To be honest, it really tells a lot about I don't know how you think. I think it was a pretty clear explanation of how you got to investing. And I was curious because you mentioned people like Lilu and Bill Ackman. I don't know if you would call them mentors, but I'm the first thing I want to know when I meet someone in the investing world is have you had any cool interactions with these super investors or these people that we all admire at the end of the day because they've done what we want to do or what we are trying to do. And so I'm really curious to know if you had any cool interactions with mentors or just if you could share anything in those lines.
Yeah, absolutely. I'm extremely fortunate to have met some of my mentors. I haven't yet met Ward and Charlie directly, but I have met Lee Lu a couple times. I've met Monish Pabrai a couple times, Guy Spear a couple times. I met Mario Gabelli, several other investors. Um, and I would encourage anybody who gets really interested in the world of value investing to buy a plane ticket and a share of Berkshire Hathaway stock and go to Omaha. Um, this is the mecca for value investing. And you can meet the people that you read about in real life. And I think that has a tremendous amount of return on investment above and beyond any share of a business that you can purchase in the stock market. Um, I think society as a whole tends to have some negative perceptions, negative ideas about the millionaires and the billionaires in the world. And maybe some of those people deserve those reputations. But in my experience, all of these people have um, become very wealthy uh, largely through their own means. So a lot of them are self made, but they're also extremely giving and generous people. And there's really only two ways to get extremely wealthy. The first is you can sell a single person $1 million item, or the second is you can help 1 million people and they each give you $1 for the value that you provide. So money is simply an exchange of value. And so what I've found to be true is generally the richer you are, the wealthier you are, unless you're born into extreme wealth, which in my view is sort of a deadly sin, then the more value that you must have provided for other people here on earth. So I met Lilu twice at Berkshire Hathaway. If you go on my Twitter, he's there with me. He is a really um, high energy person. Um, and his time is extremely valuable. Everybody wants his attention. But a few things struck me about meeting Lilu. One is most people at Berkshire Hathaway didn't seem to know who Lilu was. He was walking right by people in the hallways and nobody seemed to recognize him. Very, very humble guy wearing plain clothing, not wearing anything excessive or gaudy or anything like that. He seemed very down to earth. And when I spoke with him, you just feel the amount of energy and ferocity that the guy has. I wish I had a piece of the amount of energy that he has. He's also extremely kind, um, but he's also very realistic and he's also very direct. And so I remember I was asking him for his autograph. I brought a copy of Adam Mead's book with me, The Complete Financial History of Berkshire Hathaway. I asked Lilu to sign it along with several other investors that I met. And I forgot my pen, and I asked him if he had a pen, and he said, "I don't have a pen. I can't help you." And so, if you didn't know Lilu, you probably would have thought that response was a little bit snarky of a response or a little bit rude, but it was simply factual. It was the reality of the situation, right? And I think the best investors in the world, they just have the clearest perception of reality. They can see reality the sharpest with the least amount of distortion in their perceptions. And I think Lilu is probably one of the sharpest and clearest thinkers on the planet. Um, I also met Monish Pabrai and Guy Spear a couple times. And what struck me about Monish and Guy was just their level of creativity in entrepreneurship. And I just think about how good of entrepreneurs they are. And it reminds me of the quote that Buffett says, where he says, "I'm a better investor because I'm a businessman, and I'm a better businessman because I'm an investor." And Guy and Monish have really rocked and rolled with some of their success through some really creative marketing and entrepreneurship. Guy and Monish both paid a lot of money to have lunch with Warren Buffett before they were ever famous in the value investing world. And to the outsiders, that probably looks like something that would have been a very risky move and maybe foolish to do. Like, why would you spend so much money just to have a few hours of time with Warren Buffett? What a waste. But it was actually a very low risk thing to do. And they parlayed that experience into a huge return on marketing investment that both helped them gain credibility in the value investing community as well as launch their funds. And so now they both as well have direct ongoing relationships with many of these value investors in the Berkshire Hathaway world. So both of them strike me as really incredible entrepreneurs. And before they got into investing, Monish in particular had built a company from his bootstraps using credit cards. And this is another story that really resonates with me because it's about arbitraging the opportunities that you have. Monish, to my knowledge, doesn't come from vast wealth. In India, I think his family was, fairly so-so. And so he went to Clemson and then he went to Harvard Business School. But when he was starting his business, he noticed a loophole in the credit card system where he could simply discharge the debt if he happened to accrue it and not have very big repercussions. So he maxed out some loans from Visa and MasterCard to start his businesses, grew those to millions of dollars, and then started getting really interested in the world of investing. Started reading, Peter Lynch, the Berkshire Hathaway shareholder letters, and then he took the knowledge that he had grown over the years to form partnerships modeled after the Buffett partnerships, coupled that with the lunch with Warren Buffett, and started his own value investing partnership. So he's really done some remarkable things as an entrepreneur simply by having low risk with a highly opportunistic, creative approach in entrepreneurship.
Yeah. I think a common theme between all these mentors and people that achieve so much is that they did some really smart things, but they also failed a lot. And I've been pondering more and more about the importance of mistakes in investing, but also in life in general. I think they're a big driver for growth, but you really can't just make the mistakes and realize that you did a mistake. You actually have to act after that and fix it or correct for it in the future. So I'm curious to know from your experience and from all the books that you've read, uh, what's your system for dealing with failure or mistakes, and really what is the importance for you of making them and fixing them?
So I think again, you before the we started the podcast, you mentioned a really good book by Charlie Munger, um, Poor Charlie's Almanac, and I believe in that book, Charlie points out the importance of having role models in your life, and those role models don't necessarily have to be people who are alive today, right now. They can also be what Charlie would describe as the imminent dead, because a lot of the times people, human beings that are alive today especially, can let you down and have some big mistakes. So it's a little bit safer almost to have idols that you point to from history who have done things successfully, and you can simply look back to how they had successes or dealt with failures. So I'm always open to exploring these sorts of questions because I don't know if I have a perfect answer for you, but I'd point to two people in particular. One is Thomas Edison, the other person is Ray Dalio. For Thomas Edison, said something along the lines of, "I haven't found failure yet. I've succeeded at finding 1,000 ways that this light bulb thing won't work out." And if Thomas Edison had just given up, we wouldn't have electricity, right? And have
Yeah,
lighting in our homes.
literally.
So, so I think all the innovations in the world come from this continued iterative process of repeated failures, but then picking yourself back up by your bootstraps and trying again. And so Ray Dalio, similarly, he says in Principles, one of his books, life should feel like you're, continually failing, but then you move forward despite those failures. And so life is this iterative process of failing and trying again and failing and trying again. But over the long term, what happens is people are highly adaptable, and we learn really well over long periods of time, especially from our past trials and errors. And we get smarter and better at handling those future hoops and hurdles. And so failure is when we quit and we stay down, but we don't have to stay down. And I know in my own life, personal life, business life, I've stayed down for very long, periods of time. But the best entrepreneurs in the world, the best investors in the world, the best business people in the world, the best, any athletes, anybody who's the best at what they do, they're very good at the rebound, right? They're very good at the point of picking themselves back up quickly to get back in the game, get back on the horse quickly. So I'm trying to get better at my bounce back rate and not stay down as long. And I think if I can simply find ways to get better at managing the bounce back rate, then I'm going to have a very successful life.
Yeah, and I think you really nail it down, because one thing that in my short life I've learned is that everyone has bad moments. Everyone has highs and downs, but what makes the big difference is the readiness and the speed that you can get yourself up and stand up again and continue to go forward. And that's really basically what you said, and I really agree with your point. And it's very interesting that we are also like-minded in that sense. um, and like, could you provide any specific examples of maybe some investing mistakes that you've corrected so far, and that you can share, obviously, because I don't know if you can share and everything, but yeah.
So I don't know if I've had any terrible investing mistakes. Nothing's wiped me out. and a good, even despite going very concentrated in my portfolio holdings, and some of that is because I apply some guardrails in my approach in investing. So one of my rules as an individual investor is to know the boundaries of my circle of competence. I'm not the smartest person in my workplace, and so it's highly likely that I'm not the smartest investor on planet Earth. And I think one thing that I can do to not be so dumb and significantly reduce my risk of failure in the investment process is to apply guardrails to that process. So I only bowl with bumpers. The only time that I will actually purchase an investment in equity in the public stock market is if a value investor that I follow already has made that purchase. So this decision to buy the security has already made it through the filters of multiple of the world's best investors before I ever would consider making that investment. One time that I made an investing failure, and it might not be a failure, we'll see how it turns out, is um, shamelessly cloning Alibaba right after
Okay.
Charlie Munger
I think
had
a lot
backed
of
up the
people did
truck.
that.
It probably was a common mistake. Um, and Charlie is somebody who really doesn't make transactions frequently at all, and he's somebody who's been doing this so long that when he does make a move, it's really worthwhile to pay attention to what he did in his own portfolio. So, when I saw the news that he had acquired this large portfolio position in Alibaba, I did absolutely no research and I just immediately cloned the idea the following day. And that was probably not the wisest thing to do. I bypassed my investment checklist. There's a really good book called The Checklist Manifesto that everyone should read. And my investment checklist has a few really good things on it that should act as stop filters to prevent me from acting irrationally like that without doing my own due diligence in an investment before I take a position.
Oh,
So obviously Alibaba has gone down quite a bit. It seems like there's a good bit of country risk. Charlie Munger also has admitted that this might be his greatest investment mistake in his lifetime, but he hasn't sold the position yet. So we'll
yeah.
see how it unfolds over time. In the meantime, I'm hanging on, and I think the business is still improving.
Yeah, that's very interesting, and as you said, maybe it will still play out. Who knows? But like one thing that really spiked my curiosity was that when you mentioned the that checklist book, I've never heard of it. I'm going to read it for sure because I'm going right now through the process of updating my checklist because I feel like I just have shamelessly cloned checklists of other people and it wasn't really the way to go. I wasn't feeling that comfortable with that process, so I'm redoing that. So I'm very interested in what are the key things that you look for in a business, and how does that translate to your checklist? Or could you give us any hints of how your checklist looks like in a summarized way, let's say?
Yeah, the checklist is a living document, so it's always evolving. I can add or remove to the checklist at any point in time. As I continue to read or go about my daily life, I'll either come across an idea of something that should be added to my checklist, or I'll think of a new thought that is kind of a confluence of all the readings or listening that I do. And it could be related to investing or it could be taken from another discipline. And so that idea transfers though into the world of investing and it comes onto the checklist. But the checklist is really kind of simple. There's things on the checklist like can the business be disrupted by low cost foreign competitors? Um, you know, it, have I done a thorough investigation of the valuation of the business through a few different approaches? One being there's really only three ways that I know of to properly value a business. You could look at the net liquidation value, you can look at the earnings power value, and you can look at the value of growth, the possibility of profitable growth within the franchise. So, um, and you could also look at things like a discounted cash flow or some of the parts valuation. But have I triangulated a way that I think that I understand how this business is valued, rather than rushing in to buy the stock? Um, so there's also things that you could borrow from other disciplines too, like biology. So in biology, we learn about evolution, and survival of the fittest. So just having a clear understanding of how could this business be disrupted in terms of its competitive advantages? Are those sustainable over long periods of time? There's several different types of competitive advantages, and so in order for me to get comfortable taking a substantial position size, I have to understand about a business, what is the nature of its competitive advantage, and how durable or sustainable is that competitive advantage over time. So there's things like network effects, um, being the low cost provider, having a lot of brand equity. Companies like Coca-Cola come to mind. Being asset light. Um, there's a lot of different forms of competitive advantages, but when you tie those together, you start to get some pretty interesting synergy um, effects that kind of intertwine and strengthen, to give a business kind of a unique position, a unique niche, and a reason why it's so hard to come after its returns on capital. So my checklist is, always kind of evolving as I learn new things, but I try to run any idea that I come across from, a 13F and reverse engineer it and see if I can fit it within a framework. If it doesn't hit off the checklist, again, there's things like, looking at the management team. Is it a founder led business? Is it majority owned by the founder? So the founder having skin in the game is something that's incredibly important, because that means that person's aligned with the shareholder. If they don't have skin in the game, it's almost an immediate pass for me.
Okay.
You can look at the industry level and see, on an industry basis, is this a graveyard of company names, or are there a few players that have consistently been here over long periods of time? So thinking about, automakers, I don't know that I have a very good picture of which automakers going 10 years into the future will be the winners there. And there's so many in the graveyard. It's really difficult for me to pick which horse in that race is the best horse. But if I think about something like cell phone towers, there's really not that many providers in the United States. Companies like American Tower
Mhm.
have been, there for a very long period of time and always been, very good at what they do. And it doesn't really make much sense for somebody to come and build another cell phone tower next to one that's already, planted there. And we're certainly going to need more cell phone towers as we go, 5G, 6G, have more increasing density, and more interconnectivity of people's devices over time. So some industries seem like they're easier to figure out than others. Some companies are easier to figure out than others. But yeah, that's sort of a gist of the checklist, at least for now.
Nice. You just I just smiled because you mentioned American Tower, and it's actually 100 bagger, and Chuck Aker owns it, and Chris Mayer has talked a lot about it, and we've also chat and talked about how Chris Mayer influenced our investing style. So I'm curious to know what were the biggest ideas that you took from him, and how do you apply them in the real world and in your investments?
Yeah, I think Chris Mayer is an incredibly talented investor, and he wrote a terrific book, rewriting of 100 Baggers, by Thomas Phelps. So he updated and modernized it, redid the back studies, and it turns out that this approach is, something that most people would write off and say this is not humanly possible. But if you just keep digging, you can look at people like Chuck Akre, who you mentioned, and they have caught multiple hundred baggers. I think hundred bagger is a term that originally comes from Peter Lynch, actually.
Mhm.
But Chris's book is one that definitely resonates with me extremely heavily and altered my investment approach. When I first started, I was indexing, the S&P 500, which I still do in my 401k. But um, from indexing, you graduate into picking out a few ideas here and there, maybe cloning 13Fs. Um, but Chris Mayer's book uh, really got the idea across in my head, combined with, I guess, you could almost take Chris Mayer's book combined with the Nomad Partnership Letters. And those two are an extremely powerful combination for an investment approach. And the general gist of it is the more concentrated that you are in your portfolio, the higher conviction you need. Um, and so a business kind of has a few elements that could let it be a 100 bagger. It has a long runway for profitable growth within its core franchise ahead of it. So the management team really understands the core nature of their business. And there's a large opportunity set to continue to reinvest capital within the business over long periods of time. So they don't have to deploy that capital into other business ventures and end up in a diversification scenario. They also don't have to pay out a dividend. They can continue to reinvest directly within the core franchise of the business. Um, they can invest at an increasingly or a very high rate of return within the business. So their return on capital is very high. Um, and then over that period of time, there's a set of very strong, durable competitive advantages that protect those returns on capital. So there's some 100 baggers that are in my portfolio. I now own anywhere between 10 to 20 stocks. If I could have fewer, I would have fewer. But in order to have fewer stocks for me means that I need to be spending much more time actively investing. And because I work a full-time career, I can only, devote, 10 to 20 hours to investing in a given week. So for that reason, I try to have more than 10 holdings at this point in time, just for a little bit of diversification protection. But um, yeah, the big idea from Chris Mayer's book is once you've found the characteristics of these companies, these 100 baggers, it's almost like I think of hunting, where you can look at the tracks in the mud and you can see the imprint of the deer's hoof, and this is a deer that is around here somewhere, and you can kind of get a feel for the the company. And there's several traits of these companies that have repeated over time. So you get a feel for what you can look for that are characteristics of these 100 baggers. And then once you found it, you want to take an approach where you just never sell it. So, if you've done, Charlie Munger says, if you've done the work correctly, if you've bought the thing right, you don't have to do anything else for the rest of your life. You can just sit on your ass. So, um, I take the coffee can approach there,
Yeah.
and I'll monitor the performance of the business, every year or so. But I'm not checking prices every single day, let alone every week or every quarter. I don't think that makes a whole lot of sense at all to monitor the performance of a business on that level, even when you take a concentrated approach, because it takes so much time for a business to improve its performance and to improve its fundamentals. And so it really takes a snapshot of a 5 year period at least before you can really see how a business is doing. And you really get to know the business after you own it.
Yeah.
I mentioned the Nomad letters by Nick Sleep and Kay Sakaria. And in those letters, they go to almost an extreme of the 100 bagger approach, where they found just three businesses: Amazon, Costco, and Berkshire Hathaway. And they bought those businesses for their investors, and they just never did anything, and they just sat around all day thinking about those three businesses and what could disrupt them or how they would do over time, and they could never really find anything that was better to own than those three businesses. So they ended up returning all the capital to the investors, closed up shop, and just told them, just go buy these for yourselves, because it's no point for us to be charging you fees to do this. Just go own Berkshire, Amazon, and Costco. So that's kind of the approach. You pick the best thing that you can possibly think of owning, and then you just own it.
Yeah, that's like a funny but true story. I think there's some value in having a fund like that because you really protect people from themselves. If you have the discipline, the consistency, and the character to have that approach, you're really selling your personal traits, your personality, your conviction. So I think there's some value, but I also think that the managers of Nomad were a bit tired of just sitting on their ass, so they just I think they went on to doing some uh, some philanthropy or something like that. So that's a very interesting story, and something that I also can resonate from your background and from your approach is that you are a full-time you have a full-time job. I also kind of have a full-time job, which is cool. So I can allocate just a certain amount of time to investing. And I would like to for you to expand a bit more on how's that worked for you. How do you organize on a practical level? Do you wake up earlier to do research? How do you organize yourself in that level? Because I can imagine that having a job has its own, let's say, levels of difficulty, and then getting back home and do research and read annual reports and stuff, maybe it's not for everyone, let's say. So guide us through your process and how do you think about this?
Yeah, I think that's a really terrific question, and that's something that I have thought about a lot over the past few years. When you look at any of these investors, the question that I always ask themselves is how they do so much within a single lifetime. And a lot of it is pretty counterintuitive. Charlie Munger, again, to point back to his book, talks about reverse engineering your life. And when you have your tombstone, what do you want your tombstone to say on it? And then to accomplish those things, work backwards. So if you view your life like an annuity schedule, I probably have about 60 to 70 years left in my life of things that I need to do and accomplish before I have a tombstone. So uh, it would be really wise for me to be extremely disciplined in my goals to arrive at the destination that I want to arrive at. Um, and I think counterintuitively, you would think that in order to do so many of these things in a single lifetime, that you would need an extremely high amount of activity. But like all things, that's not really the right answer. The right answer is never what it seems. So counterintuitively, I think my single biggest skill is that I'm extremely lazy,
Okay.
and I think this is something that is it could be a weakness, but I've happened to transform that weakness into my single core strength as an investor. So if you look at somebody like Charlie Munger, or if you look at somebody like Monish Pabrai, both people are incredibly lazy, but they manage to do so many different things. And a lot of the reason why they can accomplish it is because they designed a lifestyle that allows them to have a lot of leverage in different areas of their life. So they spend a lot of time reading, and that allows them to accumulate a large amount of knowledge. So Charlie Munger doesn't just invest and read, but he also designs catamarans by himself.
Yeah.
So, and he also plays bridge, and he also goes fishing. He's a good fisher. Um, and he's also designed school dormitories and buildings and monuments and things like this. So um, laziness is definitely a clue as to how they do it. So if you clone somebody like Monish Pabrai cloning the Buffett partnerships model, it allows him to accrue a significant amount of wealth just by sitting around and reading. But then he also is open source with his ideas. So he's not actually reading annual report after annual report all the time. A lot of his approach is centered on outsourcing and open sourcing. When it comes to investing, that's something that's actually really smart to do. So Monish often asks a lot of the colleges and universities that he'll visit and conduct lectures at have very smart students, and they conduct stock pitch competitions. And he'll ask those students to send him their best ideas. But then Monish also has a very strong filter. So he has a very high hurdle rate for his opportunity cost of capital. I believe it's north of 20%. And so if an investment doesn't cross that threshold, he just doesn't bother looking at it. So investing is not a process of activity. It's not a process of finding things and saying yes to them. It's actually a process of elimination. It's actually a process of doing less and then just waiting for the really big ideas to come across and whack you over the head like a 2x4. So, and they should be extremely obvious when those ideas do come to you. So I think of a business like Rayshas. This is a warehouse operator in Turkey. And I reverse engineered this idea. I did my own due diligence on it. If you go to my Twitter profile, you can see some of the calculations for yourself and how he did it. But Monish found this company. It was trading below net liquidation value. In a nutshell, the business had uh, about a million of square feet of warehouse, and any given square foot of warehouse on average in Turkey trades between $80 to $120. So take 100 and you multiply that out to $1 billion. And then the business was very well run. It had almost no debt, $200 million of debt. So the enterprise value of the business was 1.2 billion. But take out the debt, so you pay off the debt holders if it goes into liquidation. So that leaves $1 billion. The equity was trading in the stock market on the Istanbul exchange at a fraction of its net liquidation value. So you had extreme downside protection. So the business, when I bought it, I believe was a market cap of about $300 million compared to the $1 billion of real estate value. But it gets better because the real estate is leased out to customers on inflation index long-term contracts, to customers that are, you know, Amazon, IKEA, Carrefour, very prime quality tenants whose businesses are not going away,
Mm-hmm.
who need warehouse space to get their products into country centers like Turkey. And those businesses also earn in US dollars, but then they expense in the lira, in their native country currency. So even if they have hyperinflation, they're still earning at a higher rate than they're expensing.
Right.
So these businesses have extreme inflation power. The revenues are extremely protected. The business also could be sold the next day in a private market transaction for $1 billion, but it was trading for a fraction of that. So I saw absolutely no reason not to buy the business. But then on top of that, the investment case got even better because the business is led by a father-son team, the Agelmans, and they own a significant amount of the shares. So their share ownership is directly aligned with your share ownership as the equity outside passive minority shareholder, in the words of Marty Whitman. But they also have a very high reinvestment rate within the business, and the warehouse is just one business. So they actually have multiple businesses within Rayshas. But they try to get their business back, their money back within about 3 to 5 years. And they're not running Excels, they're not running discounted cash flows. I think just up until last year, they had really an outdated website, even. So unless something gives them money, they're really not interested in deploying capital. So they have very good capital allocation skills. And I think if you simply hold on to that, which over a long period of time, I think it should do well. And it's a simple enough business that I don't need to be a rocket scientist. I can just go look up what commercial real estate in Turkey is selling for to get an idea of what the warehouses are worth any day of the week. I can monitor the performance every year or so. But I think, 20 years from now, if my capital went up 700 fold. I'll be pretty happy. But I hope I go to my grave with it, in the words of Monish Pabrai.
That's great. Yeah. And now we've come back again to the topic of cloning because Raysad is a, let's say, a famous Monish Pabrai investment. Just because of the reasons that you mentioned, was such a great and obvious opportunity. But Chris Mayer also suggests or advises us to invest in businesses around 1 billion market cap or less, let's say. And when you check the 13 Fs of these great investors, usually they don't really invest in businesses that are this small, or if they invest, it doesn't show up on the 13 Fs. So I assume you're investing in bigger cap companies, or because if if you don't, if one of your filters is to invest in businesses that are already owned by other investors, I'm curious to know if you completely eliminate all small caps, or how do you think about this?
This is an interesting question. I think if I had a preference, just thinking about it from a logical framework, you would want to target businesses that are 50 to 100 million market cap in order to have a chance at them being, a thousand bagger. If the biggest company is $1 trillion market cap. But when I look at companies like Google and Amazon with these giant market caps, they're also the strongest businesses probably in human history. And so I don't know that it's true that the trillion can't go to 15 trillion, over my lifetime. And Lilu has very few public appearances, but in one of them, Lilu talks about, it's actually not necessarily a gating factor that the size of the market cap diminishes returns over time, because you have your ability as an investor to have a difference in your holding period. So a company like, Brookfield Asset Management should be yielding north of 15%. They're already a very good sized company though. And so it's probably a very safe bet to make north of 15% over the coming 5 years. But they're probably not going to be a thousand bagger. So if you're looking for really knocking it out of the ballpark and hitting some extremely big hits, then you would want a smaller business. But it's also much more difficult to get to a very small business. I remember, looking at Amazon, the original website for Amazon. And if you go on the Wayback Machine, I ask myself, how would I have known from looking at this website alone that Amazon, this little crappy website from the 90s, is going to grow into this giant everything store? And there's a few clues there that now I continue to look for as I'm looking for investments. I just found a really interesting one the other day. It's located in Poland that I think has some interesting qualities to it. But, that original website for Amazon.com in the 90s wasn't fancy. It didn't have very good marketing. It had no pictures on it. It was just text. But it said that they were committed to offering extremely low prices for their customers and pass on the savings to their customers, and to increase the inventory and the quality of their books over time. And that idea is really tying back to the Nomad partnership letters with this idea of scale economy shared. So how can a mouse grow into an elephant? And there's really very few business models that allow for that. But one of them is scale economy shared. So if you pass the savings on to your customer over time, you create a flywheel where there's more and more loyalty for the customer to return to your store, to capture more customer lifetime value over time. and then to gain a competitive advantage, durable competitive advantage as a business to continually keep lowering your costs and keep passing those savings on to your customers. So within a given geography, there are some businesses around the world that do have that competitive advantage. Um, Amazon is one of them. Costco is one of them. IKEA is one of them. Dino Polska is one of them. Um, there's also a company that's escaping my mind in South Korea that's like the new Amazon. Um, but within that geography, those businesses have some unique niches where they can get some structural advantages and pass those costs on to customers and should be able to scale quite nicely over time. So I think it's more difficult to find these businesses at smaller and smaller market caps because it requires a better and better crystal ball. But the traits and the trend marks are still there. And you just need to have extreme conviction and things like, the founder having a very good alignment to you as the shareholder. So Jeff Bezos never sold his equity, and Sam Walton never sold his equity, and Jim Senegal never sold his equity, and Warren Buffett never sold his equity. So if you keep the founder ownership in mind as one of your investment filters, say you make 10 bets, it's probably, more of a chance that at least one of those bets, if you've selected well, will pay off, even if the other nine go to zero. That one business that goes to 1,000 will completely cancel out the other nine businesses going to zero. So after you've selected these businesses and you have conviction in your idea, you need to be like Yoda and just sit there and let the force be with you and compound over time.
That's a great story, yeah, and great answer. It really makes sense, and there's a bit of a trade-off as in everything. You get a bit more certainty in companies that have bigger track records too. So, and you get bigger track records when maybe the company is already bigger. So that's a trade-off. And there's also this trade-off that I've been thinking about recently, which is having a simple investment process. I shouldn't say simple, but having a simple investment process and also being fast upon acting on opportunities and new ideas, and also the other side of the coin, which is doing deep research and having high conviction in your ideas. I'm not sure if those are literally trade-offs, because I think you can do deep research and still have a simple process. But I'm curious to know how do you think about this? Because again, with some time restrictions as you have, I don't know how deep you can go into the details. And you also mentioned you have a slightly less concentrated portfolio than you would like because of this. But how do you think about the balance between deep research and being fast?
Yeah, that's a really good question. Within my portfolio, 5 or 6 of the positions that I own, I don't think about at all. I just own them. And I almost dollar cost average into them over time. And the reason for that is because there's a very good capital allocator at the helm of the business who's making very good decisions that I trust completely. And I would be completely comfortable putting 100% of my net worth into any of those businesses. Companies like Berkshire Hathaway or Markel Corporation. So they have very good people at the helm who I can trust completely that they're a good steward of my capital, and I don't need to monitor them at all. I don't need to read their annual reports. I know that they love what they do, and I know that my money is safe as possible with them. I don't think anything in life is guaranteed, but among all the risks we take in life, including driving to work every day, I could probably bet my life that I don't think Markel or Berkshire is going to zero anytime soon. So I'm perfectly comfortable offloading a good portion of my portfolio to people like that to manage that chunk of money for me. The other approach that I take is tying back to Charlie Munger, thinking of the mental model of a spear fisherman. So if I'm a spear fisherman and I'm in a river, I'm watching all of the fish go by, and some of the fish are small and some of the fish are bigger. But every once in a while, there's just a really big, fat, slow fish that swims by. That's the one that you want to strike at and go fishing on, and reel that one in. The other fish can go by you all day long, and it doesn't matter that they're swimming right by you. That one fat, slow fish is going to come by every once in a while. And so when you're extremely confident in your framework and your approach and your process, and knowing what you know and knowing what you don't know, that's when you pull the trigger and you reel that fish in. So I have my investment checklist when I decide to go in on an individual business. And my process, to be a little bit more specific, um, is not only looking at the 13F, but also seeing, are there already investment theses out there written by very smart people? Because I'm open source in my ideas and in my approach. So I don't need to be the world's best analyst of the business. I can hire that out over the internet. And there's sites like Value Investors Club, where you can search for a lot of different businesses and read about the argument for why that might be a good business investment idea and what the valuation is. And then try to reverse engineer it for yourself, double check all the facts, but better yet, see if you can destroy or find any error in that person's logic or in their facts and figures. The Value Investors Club has already been submitted, any of those investment theses through very rigorous framework. It's harder to get your thesis published on there than it is to get into Harvard. Um, so that's certainly one filter. Having the 13F is another filter. So that's two layers of protection right there alone. And then against my checklist, that's a third level of protection. So I do due diligence in my professional career. I do due diligence for large private equity firms when they go to buy a business. I don't do it on the accounting side of things. I do it on the market. And so I'm very good at what Phil Fisher would call scuttlebutt. So Phil Fisher wrote a book called Common Stocks and Uncommon Profits. And in it, he has the idea of scuttlebutt. And Warren Buffett says this is one of the best books on investing ever written. If there's only two that you should read, it should probably be The Intelligent Investor and Common Stocks and Uncommon Profits. But scuttlebutt is the process of a thorough investigation of a business by going into the market and talking to the customers of the business and the competitors of the business and the employees of the business, talking to other shareholders of the business, talking to the investor relations team, the management team, and figuring out what the business is all about. I think there's a credible amount of insight that you can get by doing your own due diligence that you can't access over the internet reading an investment thesis on Value Investors Club. And so, just over the past year alone, I've researched a few different industries and learned a lot of things about some pretty interesting businesses. But there's always some things that I tend to look for, like a low set of competitors, and the competitors are stable in their industry. So that signals to me that there's not a lot of turnover and there may be some sustainable competitive advantage in that industry. Um, and doing that level of due diligence too, it allows you to become a better thinker and a clearer thinker and apply a lot of these principles that you learn while you read into your active investing approach. So if you're just reading annual reports and making an Excel model of a discounted cash flow, I can almost guarantee you that you're doing it wrong, because there's a lot of things that you can't learn about a business just by reading an annual report about what the management team says about their business. And there's a lot of things you can't learn about a business just by thinking that your crystal ball is so accurate that you can run a really fancy Excel model and forecast future earnings or future cash flow and discount that back properly. I don't think the Federal Reserve even knows what they're going to set interest rates at in the coming weeks or months. And if you have a discounted cash flow, there's already some assumptions in that formula that rely on the future. And that's very difficult for somebody to do. So a lot of my approach relies on not knowing what the future holds, but reducing the amount of risk through knowing the most about a business and being a very good business analyst. And it reminds me of Lee Lu's approach when he bought Timberland. And his due diligence process was not only looking at the investment on value line and seeing the financial metrics and the statistics about the business and the price that he could pay for it, but then he did several weeks of extremely intensive due diligence, which also involved flying out to where the founder's family lived and becoming a member of the church. And he was actually spying on the entrepreneur's family and figuring out what their reputation was, right? Lee Lu also graduated with 3 degrees at the same time. So he's an incredibly brilliant person. So when you come to the game of investing, that's the kind of person that you're competing against. And you always want to make sure you're on the right side of the trade, not the wrong side. So,
Yeah,
which is very hard to do. So a lot of my process is delegating and offloading and being open source. But then when I really get interested in something, being willing to do a lot of the legwork that other people simply aren't willing to do.
that's that's an original approach, I think, because I'm used to hearing like always the same stuff from people, and I kind of had that incorporated in my own approach, but I never thought about it from that angle of delegating, let's say, the more technical, and not technical, but fundamental analysis of the numbers, and because, as Chris Mayer says, what really matters it's what's behind the numbers, not really the numbers themselves. And I also like to just send cold messages to employees of companies and figure out if they like their job, if they think the quotes, the fancy quotes the management says in the annual report is actually something factual that they apply in their day-to-day lives. And that was a very interesting thing that you just said. I'll rewatch this interview once it's published and really take some notes and see what can I incorporate in my new checklist. So that's very interesting. And actually, I have a couple of questions, but let's go step by step. My first one would be, how do you take like theoretical knowledge from the books into your like practical approach in your investing, let's say? Because once I finish reading a book, I have like 100 notes, and I have to I read them again and see what are the big ideas, what can I use in my practical approach to investing. So do you have any tips for that?
Yeah, absolutely. Well, I think the fact that you have a YouTube channel as you're learning is something that's an extremely powerful thing to do. Once you go in front of the world as you're learning something, I think a lot of people would be scared or nervous to do that, but it helps to reinforce a lot of the concepts that you take out of the books and really drill them into your head. Another thing that really helps is to not just read more books and new books, but reread the books that you've read before. So in my own approach, I have a set of books that I try to read once a year. And I'm not perfect at it. I don't think anybody's perfect at this, but rereading the knowledge that you've already kind of absorbed once or twice before is something that's also extremely powerful, because then as you continue to move through life, you have this framework in the back of your mind, these mental models that exist. and it's like a lattice work, as Charlie Munger would describe it. And I don't know how your brain works, but my brain works the following way, where I'll just be going through my daily life, and every once in a while, I'll go, wait, that's something that I read about in this book, or this business reminds me of this business from 3 decades ago. And you can have these Lollapalooza effects that Charlie Munger would describe, where 7 moons line up and all the stars align, and you just have these aha moments. And so maybe my brain is unique in that way, but the more that I read, even if it's theoretical and not applied, the more that I find myself having those Lollapalooza moments throughout my life. Also, I think the human brain works in a pretty interesting way. I make an analogy here for a pilot that's circling over a field. And the more that it's circling around the field, the clearer and clearer that the little tiny point that he's trying to see in the middle of the field becomes over time. So a lot of the ideas are not so obvious the first time that we hear them. And for whatever reason, it takes humans 7 to 10 times of hearing the same thing for it to really sink in. So there's
Yeah.
multiple levels of understanding a concept. I remember there's a video online called, 3 levels of music theory or something along the lines. And there's a piano player, and the piano player plays a song on the piano, and then he explains the music theory to a 3-year-old. And then he plays the piano again, and this time he explains the music theory to a 12-year-old. And then he plays the piano again, and he explains it to a young adult. And each time he kind of increases the level of complexity of how he's explaining the music theory. And a lot of that knowledge has come through the process of just long periods of thinking about the same thing over very long periods of time. So when I think about Warren Buffett, most of what he's done throughout his life is think about one thing. How can I take $1 and double it, right? And do that safely. And he's thought about that since the time he was a kid until now he's, in his 90s? Probably going to be a centenarian and live well into his hundreds, because he's never been stressed. He's always done what he loves. But what he loves doing is thinking about investing and the process of investing. And so if you just think about how much knowledge has compounded in Warren Buffett's brain over multiple decades, just thinking about that one thing, I would almost argue you could take all of the artificial intelligence in the world and pair it with all the other investors, throughout history, and he probably still wouldn't come close to the type of knowledge, the unique knowledge that Warren has in his mind and in his brain for his investment approach, his investment philosophy. So a lot of this comes from distilling the theory over long periods of time, over thinking, having a centered thought process on that theory, viewing the world through the lens of that theory, and then trying to disprove the theory, or borrowing from other disciplines to see how those disciplines impact the theory. So when I first got into investing, just to kind of elaborate on this a little bit, I thought that I would be reading a lot of financial statements and have to learn a lot of accounting and have to learn a lot of Greek letters like alpha and beta, which now I know are complete nonsense. But I didn't think that I would have to know so much about psychology, about human judgment, about human decision making, about the psychology of the decision making process, about rationality and logic, and the impact of the psychology of crowds and crowd behavior and influence of groups on individuals. So, group psychology, interpersonal dynamics. And in biology, as I mentioned, there's all of these things that we've learned from the life sciences: evolution, survival of the fittest, competitive nature of the world that we live in the form of capitalism, how one business eats another business alive for its lunch, just like alligators eat chickens. So, there's all of these different disciplines that I never thought could be tied into the investment process and how to think about investing. But it turns out that almost everything in our life helps us to learn more about investing. when I make my coffee in the morning, I'm learning about the process of investing. Coffee, for me, making coffee is a meditative process. It's very introspective. It calms my brain down. And I'm able to reflect and hear my own thoughts really well. And my mind is incredibly sharp. And, you know, there's lessons in that small of a moment. If you read books like Zen and the Art of Motorcycle Maintenance, which was a book recommended by Nick Sleep, you can really borrow little moments like that from all throughout your life. Lilu, uh, he talks in one of his lectures about observing his children and learning about child psychology through observing his children and how that approach has impacted his investment process. And I think all the world's greatest thinkers, they all have this really innate ability to learn from everything around them and absorb and have very good learning and observation skills. People like Charles Darwin were very good observers. They were really good original thinkers as a result. But I don't think there's really that many original thoughts when it comes to investing. I think most of what we know is already out there. And so it's a continual process of just being a sponge and always learning and soaking up more and more as you go along.
Yeah, that's for sure. And for me, even going to the supermarket is an investment journey because you see what people buy, you look on the cart of other people and try to understand what's selling more, what's selling less. So yeah, it's like uh, yeah, you can learn from literally everything, and going on a walk can tell you about what cars are selling more, or I don't know. It's just you can take lessons from everywhere. And you really spoke about something that I'm very interested in, which is the psychological part of investing, because um, one of the things that made me fall in love with investing was that this was a goal that would kill a lot of how do I say this? This is a goal that will cover a lot of goals that I have. So it's a multiple goal in a single goal. It's a financial goal, but also let's say a self-improvement goal, and learning to be, let's say, have emotional stability, how to deal with people. There's a lot of things that you learn in investing, as you said, that are not related to the financial statements. So I'm curious to know uh, what has changed in your life since you have been learning more about these concepts, psychological aspects of investing, and yeah, the emotional part. What has changed in your relationships from those, thanks to those teachings, let's say?
Yeah, absolutely. Well, as I mentioned, I never thought that diving into the world of investing would ever be so much of a journey into psychology, human psychology. Um, I think of a lot of the different investors in the world, and if you look at some of their lifestyles, there's things that I like about their lifestyles, but there's also things that I don't like about their lifestyles. And I think some of the investors have incredibly valuable time. And so the opportunity cost for them between reading about investing and analyzing investment opportunities and continuing on in the investment process comes at a great sacrifice to other areas of their life. If you read The Snowball by Alice Schroeder, Warren has actually kind of a lonely life where most of his time is just spent reading alone by himself, making decisions by himself, and thinking alone by himself. And it's impacted, his marriage and relationships with his friends or family, to my knowledge, um, to some degree. So there's always a trade off in life in how you spend your time, and you can't spend your time doing everything, unfortunately, in this lifetime. So you have to select among the different opportunities that you have and spend your time in the most valuable way possible according to your own standards. As far as how investing has impacted other areas of my life, I think from a financial perspective, it's obviously improved my financial circumstances and the circumstances for my family, and it will continue to do that throughout the rest of my life and beyond it. But outside of finances, in interpersonal relationships, Charlie Munger has a very high threshold for the kind of quality of people that he allows into his life. At the last Berkshire meeting, he was talking about how one of the best things you can do in your life is to immediately cut out any people who are negative and toxic and drain the good energy away from you, and just distance yourself from those sorts of people and surround yourself with the kinds of people that you aspire to be like, whether they're living or dead. And you'll naturally gravitate towards being more like those people over long periods of time, just simply from being around them and surrounding yourself with them. And so it's interesting to me that people, despite being extremely good investors who are often contrarian and tout themselves about their ability to not be influenced and think for themselves on their own, can still be influenced to a great degree by other people. I think that's one of the reasons why Buffett isolates himself away in Omaha, far away from Wall Street. And you can use these things to your advantage to improve the quality of your life over time. So I've not been so vicious as to completely cut people out of my life like Charlie Munger or Monish Pabrai often say to do. I try to give people a second chance to learn from themselves and come back around, knowing that it's often probably not possible. But for myself, I'm always trying to continually learn and become better over time. And like you said, from a self improvement perspective, if I'm not continually growing and challenging myself, then I'll get stagnant and bored, and my life just won't end up the way that I want it to. So it's a continual process of just consistent, dogged, incremental progress over very long periods of time, not just in your investing returns, but in the returns on your relationships, the returns on your health. I think Charlie's idea of paying up for quality is something that I started to do outside of just acquiring businesses in the stock market. So when I go to the grocery store, rather than just looking for the cheapest foods, why not pay up a little bit and get something organic and cage free and natural? That would have a pretty good effect on your health over the long term. So it's not just compounding capital; it's also your health and your wellness and your relationships that compound over time. And finally, your reputation and your relationships compound over time too. And when that happens, whether you like it or not, you are a brand, you are a reputation. And so if you go about the world unconscious of the impact that you have on other people, people will still perceive you in some way, regardless of whether you control that narrative or not. So I think it makes a lot of sense to try to live your life the best way possible, imagining like every day is your last day that you have here. And how can you make the best decisions that single day to have the most success and the best outcome for not just yourself, for everyone else around you too.
Yeah, so that's great. I really also liked your answer on this topic because it's really a fact that your passions influence your whole life. It's not just your career or your personal life. What you choose to do influences the whole system. So it's also interesting to learn from other investors what to do, but also what not to do. And as you mentioned, I also recently read The Snowball, and there are some parts where you can really tell that investing has done some damage into Warren's life. Maybe he has corrected that over time. I don't know, but it's interesting to learn from those lessons too. So to finish our amazing chat, I have this little game that I always that I started to implement in my podcast, which is called the fire round. And I will tell you some words, and you have to give me your first thoughts in a short sentence or one word. Tell me if you're ready.
We're ready to go.
Okay, so first word would be Charlie Munger.
Wisdom.
Okay. The second, it's choosing a wife.
Extremely difficult.
Third one, software businesses.
Recurring revenue.
Fourth one, Tencent.
A pretty good business.
Okay. And to finish, best book.
Poor Charlie's Almanac.
Okay, great. You were actually the MVP of the fire round because the other guests just take too long to answer and they give long answers. So congratulations.
Well, awesome. Well, David, thank you so much for having me on the podcast. Really appreciate it.
Yeah, it's great to have you too, and I hope we can chat in the future because I really enjoyed our time here. I learned a lot, and maybe getting some feedback on my ideas, investment ideas from you would be very valuable. And if I can offer you some help with your YouTube channel, I will also leave down below the links of your Twitter. I've heard you mentioned your Twitter account, and maybe that's a valuable resource for people. And then you will provide me the link for your YouTube channel, and I'll also leave that in the description. So yeah, thank you so much.